6 months ago in this video, I shared that banks will likely raise dividends for 2022. And also mentioned there was that markets seem to be willing to pay more for banks' assets, and markets are expecting banks' book value to grow. Hence you'll see 6 months, this is the price trend for UOB, DBS and OCBC. Top performer is UOB. Today in this tutorial I'll share with you new updates because UOB and DBS have released their earnings already. And because markets are volatile due to the war in Ukraine, I thought of producing this so that you have an idea where you can deploy your monies towards. I'll also be sharing with you my thoughts on buying banks right now because they seem to be at all-time high and many are concerned about getting in as of right now. So if this topic interests you, continue watching on. Hi guys, welcome back. Let's start with DBS, and I've actually prepared some material from an analyst report. They deep dive into the trends as well as the books. So let's tap on their expertise. What we can see over here is that the positives include fee increment 9% year on year for DBS. DBS has grown their wealth management, they do like that, and transactional services. DBS, why I've always liked them quite a bit is because they are open to crypto space. And what we can also learn is that loan has grown by 9% year on year in 4th quarter 2021. This full year loan growth of 9% is the highest in 7 years. All pretty good news, correct? Because banks, their core business is in lending money and making interest income. But let's balance the view with the negatives. Over here, net interest income and net interest margin, NII and NIM, have remained relatively unchanged. DBS's net interest margin remained flat as a result of lower market interest rates as consumer deposits have grew 3% quarter on quarter. Now when they collect more deposits, they have to pay more interest. And if they collect more deposits than what they can lend out, then naturally the margin would start to drop. But that typically can change from quarter to quarter. Now let's look at something more important, which is the upside from higher interest rates. As you probably have heard already, 2022 would likely see some level of interest rate increments. And DBS has mentioned that 1 basis point rise, 1 basis point is 0.01%. 1 basis point rise in interest rates could raise net interest margin by 18 to 20 million. They have a sensitivity of 2% for every 10 basis points. And assuming that there's 2 rate hikes of 50 basis points this year, DBS could see a climb of $2 billion, resulting in an increment of their full year 2022 earnings by 26%. That's fantastic news, correct? DBS core loans are in Singapore, and they are the ones that benefit the most supposedly of the three if interest rates rise. And there's further good news. DBS has actually recently acquired the CITIBANK's Taiwanese operations. They will pay $956 million premium over net asset value. This acquisition total will be 1.8 times book value, which seems expensive on first glance. But DBS has previously acquired and integrated ANZ's wealth management in Taiwan and BOA's commercial bank more than 10 years ago. So they are used to doing deals in Taiwan, and they are now Taiwan's biggest foreign bank by assets. But as you can guess from the presentation to here, you know my style is to always keep the good stuff towards the end, right? So smash your like button if you have benefited so far, and I'll show you why I think UOB might be the best of the 3 banks for the coming quarters ahead. Again, it's my step in the dark. These are 3 outstanding banks, and it's really hard to tell who would outperform in share price. But let's get the overall trend correct. Now, why do I think UOB might be the one that is going to perform the best for next few quarters? It's because UOB focuses a lot on ASEAN. They have business in Malaysia, Indonesia, Vietnam, unlike DBS who focuses on Greater China and Singapore. OCBC has a bit of Greater China, but mainly there's some revenue coming in from Great Eastern, which is the insurance arm. So UOB really does a lot of loans throughout ASEAN, and if indeed ASEAN recovers from COVID-19, because Singapore is probably the fastest to recover. If Malaysia and Indonesia get their act together and start opening up well, they could see their economies revive a lot stronger. And not only that, UOB has also purchased something from Citigroup. They have purchased their ASEAN's operation. And with that, UOB will bring on 5,000 employees from CITIBANK, who operate the Indonesia, Malaysia, Thailand and Vietnam businesses. Now, UOB has actually mentioned the purchasing price, which is close to $5 billion. And this is actually a 1.2x book value. But there's more. UOB's management has claimed that a 25 basis point increment in rates could add 150 to 200 million in net interest income. This is slightly lower than DBS simply based on the size. We think UOB's ASEAN strong integration should allow them to benefit from high margins as borders and trade open. That is what I've mentioned just now and something that I do agree on. And from the latest performance, UOB has managed to keep their net interest margin stable at 1.56%, which is higher than DBS also. And UOB has been paying generous dividends. They have not only increased their interim dividend to 60 cents, they are now increasing their final dividend also to 60 cents. So at $1.20 dividend, the current dividend yield at around $32 per share is about 3.75%. Now I want to give you a rounding point to things. I don't know when you are viewing this and whether the war has become worse or not, and whether markets have crashed. If they do indeed have crashed, I think bank stocks are a very simple idea to get invested into. I've seen questions what to buy, and I think one of the more reasonable ideas is buy STI ETF because it buys the 3 banks directly. What I can show you also is STI ETF's weightage towards the 3 banks have increased simply because they have done the best in terms of share price. Previously, STI ETF's weightage to banks was about 43%, right now it's about 48%. UOB themselves have been the second best performer on STI index, only trailing Sembcorp. But having said that, I still believe that book value wise, it is not expensive. If we see the price to book chart over here, you realize that it's still below its 20-year average of 1.5 times book value. Don't get me wrong, it's not cheap, it's just hard to justify that it's expensive and you have to avoid even though it's at all-time high. DBS on the other hand looks to be slightly more expensive. All the good parts have been factored in already. Hence, I do believe UOB could continue run well against DBS. OCBC seems to be the obvious laggard, and maybe they do need to increase their dividends to get a bit better in terms of sentiment. But I'm still running with UOB as an idea because they have the best exposure to ASEAN and they have recently acquired something from CITIBANK to strengthen their ASEAN book. So let me know your thoughts and comments in the sections below, and as always, if you have benefited, smash the like button. Invest safe, not sure, just buy STI ETF. That is always a reasonable recommendation. Although STI has lagged the 3 banks' performance, that is because banks typically run fast when the economy recovers. And after that, the other industries such as property, REITs, telcos start to catch up. So STI simplifies your investment approach and gives you exposure to our 3 fantastic banks in Singapore. With that, I'll sign off from here and invite you to smash or subscribe. 6 months later, I'll do another review and I'll see you then too. Take care and goodbye.